Hello and welcome back to Stock Analysis, and today we are going to be looking at Legal& General Group, or LGEN stock ticker. And that is right. So before we go and see if Legal & General is worth adding to the portfolio, just before we start, I am not a financial expert. This video is for educational or informational purposes only. And I'm not a financial expert or advisor. Nothing in this video should be considered financial, investment, legal, or tax advice, because your capital is always at risk, and investing could also lose you a lot of money. So please do your own research, because you're responsible for your own financial choices. But that disclaimer out of the way, let's go and see what Legal & General is all about. So what is Legal & General Group? Well, Legal & General is a leading UK financial service company and a major global investor. Established in 1836, it offers a range of products and services, including investment management, lifetime mortgages, pensions, and life insurance. The company is headquartered in London and is listed on the London Stock Exchange, and of course, being one of those in the FTSE 100 index, or FTSE 100 index. So, as the time of the recording, the price was at £2.71. We've already mentioned it's in the UK, and we've already mentioned it's a financial service stock. The market cap at 10.8 billion, with the IPO at 1986. Now, the dividend growth is 14 years and running, with a 5-year dividend growth at 5.8%, but the dividend yield is at 7.1%. And as you can see, year to date it's up about 3%, 1 month is 3.71%, 10 years 25%, 5 years is only 3.55%. So, pretty much not really great figures if you look at that from a perspective of that, but of course all time is up 448%. So as I've already covered, what is free cash flow is important. You can feel free to pause this slide and see what free cash flow is before I go over and cover it. But basically that is the standard of what it is. So the Legal & General free cash flow, is it really bad? Because, as you can see, it hasn't really been growing steadily. It's been up and down. And as an investor yourself, you're thinking, free cash flow isn't growing year on year, so why should I invest in that? Well, you are right, because at first glance, it looks very volatile, even negative in the recent years, which, of course, looks worrying. But this is where the understanding of the business model really matters. For insurers, like Legal & General, free cash flow is often not a reliable metric, because large analytic transactions and investment movements flow through the operating cash flow. This creates big year-to-year swings that don't necessarily reflect the health of the underlying business. Because of this, Legal & General does not pay shareholder returns on free cash flow. Instead, dividends are funded through capital generation and surplus regulatory capital. And as we've mentioned, we'll come on to the dividends. So this brings us very nicely onto the dividends, which is at nearly 7.1 to 7.9% roughly. As you can see, I've got the roughly percentage mark because it is changing day on day, and by the time you're probably watching this video, it's probably either gone up or down. So it remains slightly below its 5-year historic average of 8.3%, reflecting recent share price movements rather than dividend weakness. Now, of course, over the past 5 years, dividends per share have grown by approximately 56%, demonstrating a clear commitment to income growth. Dividend payments have remained consistent and resilient. I love my English sometimes, even through periods of market volatility, highlighting management focus on shareholder returns. Importantly, dividend sustainability is supported by capital generation and balance sheet strength, rather than short-term free cash flow. And as you can see, you might notice some few things on the chart. Now, as you can see, it does say on the screenshot that dividend streak is actually at 0. Well, technically, yes, on the chart, it doesn't actually grow because the way London stocks pay out is they pay a interim dividend and they pay a final dividend. So for the chart, it's not growing because you pay a higher dividend and they pay a lower dividend at the final part of the year. So they pay start of the year and then they pay in July time roughly. So as you can see, in January time they paid the interim dividend, and then in July time they paid the final dividend. But the interim dividend has always been growing, and also the final dividend has also been growing too. So in hindsight, plonk it all together, the dividend growth has been growing, and that's where you get to the dividend growth. The Legal and General Group fundamentals. Now let's have a look. So Legal and General reported revenue is highly volatile over time, and that isn't due to a collapse in business. It's driven by accounting, investment income, asset revaluations, and energy transactions. This is why revenue growth rates for insurers can look misleading. Management focus more on operating profit, capital generation, and return on equity. So large year-to-year swings are driven by, like we say, investment income and transactions, which flow through revenue for insurers that can short long-term growth rates. While the last annual growth was 32.3 billion, the negative 5 to 10 year CAGRs largely reflect the periods of exceptional gains and losses, rather than a decline in core operations. As a result, like we mentioned, revenue is not a primary performance metric for Legal and General. So, operating income then. So at first glance, Legal and General's operating income looks like it's trended down, with negative growth rates over the last 3, 5, and 10 years. However, let's add some important context to that. As we keep mentioning, insurers like Legal and General, operating income is heavily influenced by accounting adjustments, market movements, and one-off items, rather than just a day-to-day business performance. You can see large spikes and drops in earlier years, including a significant one-off loss, which distorted long-term growth rates, which makes CAGR fixtures look worse than the underlying reality. In more recent years, however, operating income has been lower and relatively stable, reflecting a bit more mature and a capital-efficient business model, which is quite good because you want it to hopefully start growing. But as we keep mentioning, Legal and General and other people like these will keep going up and down and won't be always consistent year on year. So, operating income on its own isn't the main measurement for management or investors rely on. Instead, the focus is on capital generation, return on equity, and solvency strength, which is better capture the company's ability to generate value and support dividends over the long term. Which leads me very nicely on return on equity. So, of course, ROE, or return on equity, is one of the most important metrics for insurers. It tells us how efficiently the company turns shareholder capital into profit. Right now, Legal and General's ROE is around 8.9%, slightly above its recent average of 8.2%. For a large insurer, a high single-digit ROE is generally considered healthy and sustainable. Most importantly, ROE links directly to capital generation, which also supports dividends, which is very nice indeed. Now, it has gone down lately, as you can see. The average is at 8.2, but current is 8.9. But in the later years, it was actually up at 20%, which was quite good indeed. But as we've mentioned, a high single-digit ROE is generally considered healthy, especially for companies like this. So let's move on to more of the fundamentals. So net income and EPS. Well, net income and earnings per share are volatile, which is typical. Earnings swing due to interest rates changes, market movements, and actual assumptions to other people's stocks and investment ideas. And this makes the long-term EPS growth rates less meaningful, which is why, as we keep mentioning, investors focus on the capital strength instead of these metrics. Like if you were doing, for example, Coke or anything, you look at these metrics and you make your decision because you hope that it's growing. But Legal and General, this is pretty much the same, but you can't use the metric for your decision making. Because as you can see, the 3 to the 5 and 10 year CAGR figures have been distorted by the periods exceptionally high earnings followed by normalization, making long-term growth rates look less meaningful. But how does Legal and General make its money, and where is the profit actually coming from? Well, Legal and General operate across several key areas. We've got insurance, which is the foundation area for Legal and General, offering a broad spectrum of insurance products, including life insurance, critical illness cover, disability insurance, and just general insurance products like home and auto insurance. We've also got then the savings and retirement, which Legal and General started to be heavily involved in, providing savings solutions, retirement products. This segment includes personal pensions, retirement income, which is designed to help individuals plan for their financial future post-retirement. We've then got investment management. Through Legal and General, LGIM, the company manages assets for institutional and retail clients, and LGIM is one of the largest Europe's asset managers, offering a wide range of investment solutions, including funds, index strategies, and tailored investments mandates across various asset classes. We've then got capital and development, which is focused on capital generation, large-scale urban regeneration projects, and Legal & General invest in long-term capital products, often including infrastructure and housing. And as mentioned, mainly general insurance, while closely related to the broader insurance category, Legal & General provides products specifically under general insurance, including home, travel, and pet insurance. So going on to the other fundamentals, as we can see, I've actually gone backwards. 2 is price and book. So for insurance like Legal & General Group, this is one of the most important valuation metrics because book value closely reflects the regulatory capital. Historically, Legal & General have traded around 1 to 2 times book value, which is fairly typical for a mature insurer. You can see though that in multiple years it fell around 2019 to 2021. As markets became more cautious due to low interest rates, regulation, and uncertainty around future returns. More recently, though, the price to book ratio has moved higher, reaching more richer levels by 2022 to 2024. This suggests the markets become more optimistic, pricing a stronger capital generation, higher interest rates, and improved confidence in the long-term profitability. The key takeaway of this, though, is that today's valuation reflects higher expectations than in the past. So while the dividend remains attractive, the stock is no longer priced as cheaply on a price book value basis, as it was a few years ago. So the PE ratio. Well, the PE ratio compares the share price to reported earnings, but for insurers like Legal & General Group, this metric needs to be treated with a little bit of caution. For most of the period, it's shown that Legal & General has traded relatively low and stable PE, which is very typical for a mature income-focused insurer. However, in the recent years, the PE ratio has spiked sharply, but this doesn't mean the share price suddenly became very expensive. It mainly reflects a drop in reported earnings due to accounting adjustments, market movements, and once again, one-off items. When earnings fall temporarily, the PE ratio can drop dramatically, even if the underlying business hasn't changed much, and that's what you're seeing exactly here. So this is why PE ratio on its own is not a reliable valuation tool for insurers like Legal & General. Wall Street estimates. So we are going to go on now to what Wall Street is thinking about this stock. Now, I have covered this on future past videos, but Wall Street is basically analysts on Wall Street are saying what they think a forecast will be in 12 months' time for the stock. And of course, if you want to pause this and read the whole thing, then you can feel free to do so. But Wall Street targets 1 year on, and it doesn't look great for Legal & General. The lowest forecast is suggesting a minus 24% downside. The average forecast is roughly on point with a minus 1% downside, but the highest forecast is seen a 31% upside. Now, once again, these are analyst estimates, and they can get this wrong, but they can also get this right. But they are just forecasts, so just use them as a reference point, not as a decision-making tool on their own. So what is the overall risks? Well, no stock dive is complete without looking at the risks, especially for stocks like Legal & General. The business is sensitive to interest rates, where higher rates can support profitability and capital generation, but sharp changes can create short-term volatility in asset values, earnings, and market sentiment. As a large investment manager like Legal & General, it's exposed to market investment risk, meaning downturns in equity and bond markets. While dividends are supported by capital generation rather than free cash flow, a sustained slowdown in capital generation could eventually put pressure on dividend growth, particularly given the high yield and income-focused investor base. And finally, as a mature business like Legal & General faces growth and executional risk, with limited upside for expansion and returns increasingly dependent on the management's ability to allocate capital efficiency and execute the strategy effectively. So is it an add or is it an avoid? Well, for me, Legal & General will be a hold if you're in it already, but not an add. Not at the current price anyway. While Legal & General remains a high-quality, income-focused insurer with a strong capital position, the current share price reflects much of that strength. The valuation metrics such as price to book and earnings multiples suggest the stock is no longer clearly undervalued, limiting the margin of safety for new investors. From a disciplined investment perspective, this stock to hold on if already owned, but not one to add aggressively at current levels. That said, there are still very good positives supporting the investment case. The high dividend yield at 7.8%, providing attractive income, consistent dividend growth over the years supported by capital generation, strong solvency and capital buffers supporting dividend sustainability, and a well-established position in pensions, asset management, providing stable long-term cash flows. These strengths make Legal & General a solid income stock for consistent shareholders, but once again, at today's valuation, they do not offer a compelling enough margin of safety to justify adding a new capital. So if you found this breakdown useful, make sure to follow weekly portfolio updates and make sure to leave a like, hit the subscribe button if you want to see more stock deep dives. Hope you guys enjoy, and I'll see you on the next one. Goodbye.